what I wanted to do was take a few minutes and talk about a very hot topic that's been coming up virtually in every strategy session that I've done in probably the last 2 weeks. And that is how to basically use the valuation model to value the energy sector as a whole, and then take a look at some individual names relative to that. And I guess the biggest issue that we're facing right now is obviously the near-term decline in crude oil, and we still have valuations in the energy sector that appear to be a little bit lofty. So what we're going to do is I'm going to show you the traditional use case that we've already been through several times on how to actually back into the market implied growth for the equal weighted average stock in the S&P 500 energy sector. What we're then going to do is we're going to take our analysis one step further. A lot of this, most of you probably haven't seen, but we're actually going to use the valuation model to back in to what the buy side is actually bidding the crude oil recovery to be out in 2017, 2018, and even beyond. And then we're going to take a look at one of the most commonly requested stocks to do a strategy piece on over the last couple weeks, which is Transocean Rig. So I hope you guys find this really, really interesting. It's been very interesting. So in default, you'll see right away that we've got consensus estimates for long-term growth rate of earnings ticking in at about 6.3%. But take a look at what happens to our growth rate when we take one standard deviation off in default. We come down to a negative 4.38%. So you can see that right now, in default, the valuation model is coming up with a normalized earnings trend whose fulcrum is not only in the wrong place, but it's basically its trajectory for earnings is into Armageddon, if you will. Obviously, we can't continue declining indefinitely at negative 4.38. So we've got two issues we've got to address with the default settings right away with the valuation model. And this is probably one of the reasons why this is so common is people are pulling this up and they're saying, wow, this doesn't really make sense. Actually, it does, because the valuation model is trying to tell you, hey, we've got literally two red flags here. A, we've got a trough or an earnings recession in the energy space that's one of the deepest we've seen in several economic cycles. And since the valuation model fulcrums the earnings point on the forward 12-month earnings, that's literally sitting at the bottom of the trough. So we need to do exactly what the buy side is doing and look 24 months out and even beyond for that recovery and model that recovery to see what that looks like. So the first thing that we're going to do is we're going to note the sell side forecasts. We're going to acknowledge them, and then we're going to dismiss them for a minute. And we're going to set the model up to where the buy side is basically expecting growth to rebound. So this would be a minimum point at which the buy side we would hope would expect this earnings recovery to actually take hold. What we're actually looking at is the sell side forecast, obviously, for earnings. And the nice thing about the sell side forecast for earnings and the manner in which we implement this into the valuation model is that these estimates implicitly include a forecast estimate for the underlying price of the commodity crude oil. And it only makes sense if you guys have seen the broker models. You'll know that each of these analyst models that end up deriving an FY1, FY2, FY3 estimate for earnings has an underlying assumption for crude oil pricing. So when we bottom-up aggregate that into the S&P 500 equal energy composite, those forecasts for crude oil are baked in these numbers, which is great. So what we've done is we've shifted our fulcrum point from F12M to F24M. So we're just going to focus on this green diamond for now, and we're going to keep this green diamond aligned on the forecast sell side earnings recovery that is actually projected to take place in 2018. Notice that we lag earnings by default in the model. So if I unlag earnings, you'll actually see that that's a 2018 point. I'm going to go ahead and lag them again. Again, the reason why we lag is to give you a visual fit for it's a better visual representation of valuation versus using a trailing number. But at any rate, what we can do now is we can actually back into a market implied growth rate for the S&P 500 energy sector, and assuming this recovery point in earnings. And all I need to do this is literally bring the growth rate up by using the right arrow here to the point where the current model return hits 0. And notice that every single click I do on the right brings it up 10 basis points. That would be the growth assumption. So we're actually modeling higher and higher growth. And notice that each click I do, the model return begins to approach 0. Model PE begins to approach actual PE. Model price begins to approach actual composite price. And we actually have a little button here where you can click, just click on market implied growth. It'll actually set the current model return equal to 0. At that point, we have a market implied growth rate. What I want everyone to be aware of is that in default, the valuation model itself is always going to fulcrum on 12, F12M EPS. So if you think of it like a seesaw, to the extent we've ratcheted up the growth rate, this is our fulcrum point. Our green diamond, which is F24M earnings, actually came above the earnings line. So we actually need to back that back down if we're going to hold it to the consensus, the sell side forecast for earnings. So now I would need to click on market implied again. So you just do it kind of twice. It's like a double iteration to actually get at the market implied growth rate. So what is this telling us? Well, basically what this is telling us is it's saying the buy side, based on the sell side forecast for earnings in basically F24, is basically valuing the equal weighted average stock in the S&P 500 energy sector at basically 15% growth long term. And the first thing we have to ask ourselves is, what's the growth been for the S&P 500 energy sector over the past 25 years? And we can look at this on a least squares basis by just clicking least squares. And when we do this, you'll see that it's only 11%. Okay? There's another thing we can do here. We can come back and we can get really aggressive, and we can say, look, over the last 10 years, what has this space grown at? And when we do that and look at least squares, we get something obviously a little bit different. So clearly, the S&P 500 energy sector over the last 10 years has been under extreme fire. You know, the earnings growth just hasn't been there, and it's probably safe to say that, you know, going out into the future, the next 10 years could be a little bit flat, maybe, you know, a slight increase at best. But what we're going to do is we're going to take the assumption that at best, so I'm going to go back here and set this back up the way we had it. Let's bring my fulcrum point up, market implied growth, and there's roughly my 15.53, 15.38. Okay, so this is basically the market implied growth rate that the buy side has bid the energy space to. And what we're going to say is we're going to say, look, the equal weighted average stock in the S&P 500 over the last 20 years has only been able to grow at, what did we say? The least squares on this thing was 11%. Right now, the buy side is paying 15.38%. So what is that really telling us? The nice thing about this is that macroeconomically speaking, what it's telling us is the buy side has a much more aggressive rebound in store for crude than the sell side is otherwise forecasting. And the reason why this is so interesting is for those of you that have been paying attention to crude oil prices over the last several weeks, crude oil has been falling to multi-month lows now. And energy sector valuations, on average, really haven't reflected that. They've kind of flatlined. They haven't fallen. And so we've got this dispersion now coming about. And so we can use the valuation model now to not only from a macroeconomic perspective say, we've got about a 4% market implied growth premium built in on excess rebound and expected crude pricing over the next several years. But what we can actually do is we can get a visual for exactly where this earnings rebound is being bid to go from the buy side. So we can actually back into a market implied F24M earnings forecast. And this is the real power of the model. So we can take it just beyond backing into market implied growth. And now we're going to say, okay, we've done that. Now let's take a look at what the buy side really thinks crude oil price rebound is going to look like. And to do that, what we're going to do is we are going to set the 15.38 at the long-term lease squares trend. And keep in mind, we've already determined that this long-term lease squares trend is a best case scenario for valuation, right? Because over the last 10 years, growth has actually been negative, and probably over the last 15 years, we've maybe grown at GDP growth, okay? So 11% is extremely optimistic, but we'll take a look at this nonetheless because there's value here. So just knowing how to manipulate these charts and everything is really the reasoning behind this exercise. Okay, so I'm going to set market implied growth rate, and watch what happens. Every time I click this up arrow, what I'm going to do now is I'm going to shift my fulcrum point for the model. Every time I click it, it's going to go up 1 penny on forward 12 and forward 24-month earnings. And watch what happens as I'm doing this. My current model return starts increasing, but watch what happens when I click on the market implied growth rate. It starts coming down, okay? So as we continue to raise our earnings expectation, this makes sense, right? Because if we're baking into a DDM type model, higher level of fulcrum earnings, when we discount that back, we're looking at a lower market implied growth rate. So now we're going to get down to that long-term lease squares trend rate by just continually clicking this up. And I'm just going to say it's about 11.5. So I'm going to go up a couple more cents. Keep clicking market implied till we get there. And lo and behold, what we have is now we have a market implied growth rate that equals long-term lease squares trend. So the takeaway at this point is, if the energy sector were to come back into the range of at least market implied growth rate at long-term lease squares trend, what would earnings look like? Earnings would have to recover to this point, okay? But right now, the sell side is only forecasting a rebound to this point, okay? And this difference in earnings expectation between the buy side and the sell side is what's accounting for the difference in market implied growth at this point versus where the buy side has actually bid the current valuation to in earnings, which is right here, okay? The interesting thing is, if we get really, really conservative and we want to model something around 5%, you guys get the idea, valuations are still obviously going to be extremely lofty because, you know, to get a market implied valuation of 5%, we would have to bring earnings all the way back up to where they were, you know, sometime around here. So there's huge value in this. It's basically telling us that, you know, at best, anytime we look at one of these energy stocks, you know, take a look at the long-term lease squares trend in earnings growth and realize that, you know, this growth was achieved largely by, you know, levering up, making acquisitions, and a lot of balance sheet manipulation, and that going forward, there's probably not going to be that kind of opportunity. And so I would not look to any energy stocks that have market implied growth rates in excess of their 20-year long-term lease squares growth. In other words, the most you should be paying for an energy stock would be its 20-year long-term lease squares growth. Right now, we've got valuations on average that are far in excess of that, to the tune of about 4%. So let's take a look at two stocks that have been very popular. Let's take a look at Rig. And what I want you to notice, first of all, is I want you to notice the V-shaped recovery the sell side is forecast for the equal weighted average stock in the S&P. And then I want to take a look at a driller, and I want you to notice, first of all, what happens when we have forecast estimates that are just completely negative. We get this message up here, and all you need to do at this point is literally just bring the forecast earnings line back into positive territory using the up arrow, and I just use it on my keyboard. But notice we've got a U-shaped recovery, okay? And remember that we're lagging earnings by 1 year, so if we take the lag off, notice that this recovery point is not until 2019. And notice we only have a 1.35% dividend, okay? So we're going to put the lag back on. Just understand this is a U-shaped recovery. So at best, what we're going to do, again, is we're going to focus on our fulcrum here of F24M, but notice that the buy side is probably looking all the way out to the recovery here, and probably trying to draw some valuations off of that. So even further than F24M, just given the depth and length of recovery of this trough that's been forecasted by the sell side. So what we're going to want to do is look at a market implied growth rate that more or less puts our normalized earnings trend through this point in 2019. And so what we're going to do is we're literally just going to snap this to the market implied growth rate, and we're going to ratchet that down maybe a little bit. And you can see that this one's coming in at right about 16.3% market implied growth. If you look at Transocean, and we'll look at Lease Square's growth here in a minute, you can see that this thing has historically only grown at 9.22%. This thing's only paying a 1.35% yield. If I were to take a look at long-term Lease Square's growth rate since probably 05, it's flat at best. So the most we would want to pay, obviously, is 9.22, but I would argue it's probably not even worth that. And the reason for that is just given the depth of this cycle and the length of the recovery term and the fact that we're not getting a dividend, we're looking at a stock whose long-term Lease Square's trend rate at best is 9.22%, currently trading at an implied valuation of 16.3 for a 1.35% dividend. Seems extremely, extremely expensive. Then we take a look at a stock like Chevron. Again, speaking to the true value of the model here, we can see a completely different scenario play out, and I'll set this into default. Again, in default mode, notice that we've got just some really sporadic data coming in from the sell side. Nobody really knows what this recovery is going to look like. It's the reason for this exercise. We've got forecast growth, positive 10.2, take away one standard deviation. We drop down to this Armageddon scenario again. So again, all we need to do, we know what to do now. We just need to make some adjustments to the model. We know that our fulcrum point needs to be at least F24 to model this recovery. The first thing I'm going to do is just hold down the arrow key on my keyboard, and I'm just going to align that expectation to first model that sell side forecast for recovery up to 2018. And then we will basically snap to the market implied growth rate. I'm going to come in just a little bit south of the line because I know that my fulcrum is going to actually push it up. So I actually didn't even go south enough. So I'll bring it back down now so that that green diamond F24 earnings is on the earnings line. Click market implied again. Notice that I've only got a 6.36% market implied growth rate. I've got a really nice V-shaped recovery being forecasted, and I've got a 4% yield while I'm waiting for this rebound. Okay? What's the long-term Lease Square's trend rate on Chevron? 9.82. Okay? This is a much more palatable type of scenario to take a long position in if you need exposure to the sector versus something like a Transocean. We got much less risk being forecast in not only the depth, but the duration of the trough. We've got a dividend yield that's 3 to 4 times that of a Transocean. We've got a stock trading at basically a 33% discount to its 20-year long-term Lease Square's trend growth rate. On a relative basis, Chevron obviously being much cheaper. That being said, we've still got the same analytical issues with Chevron as far as growth. Are they really going to be able to grow long-term even at this 6%? They really haven't done that even since the recession. They started a nice blip here, a nice run, but obviously ever since the end of 2010, it's been pretty catastrophic for this sector. So again, we have to look at these things long term, but I always like to take a look at growth between the recessionary periods, and then obviously looking at a 20-year period as well, realizing again that a lot of this growth that occurred from 2001 to 2008 was very levered. A lot of roll-ups, a lot of acquisitions contributed to that. So will we see that in the future? Who knows? But again, this is the real value of the model. And hopefully you guys have now seen a little bit different use case of being able to actually model what a recovery in crude oil is actually being forecast as being bid up by the buy side. So what that earnings recovery actually looks like on an equal weighted average basis for the S&P 500 energy sector, again, is something like this versus this. So there's a lot of optimism baked into energy right now. I don't know if I agree with it or not, especially if you take a look at what's happened to crude oil just in the last several weeks. We're sitting again at multi-month lows and currently the valuations in the energy space itself have not reflected that decline short term. So again, everybody's got their eye on the long-term trend. And I think with regard to the buy side, everybody realizes that this recovery in crude oil is literally going to be a roller coaster. But I still think the valuations are extremely lofty in this space. So anyway,